As long-term investors, we should be looking through the current pandemic paranoia and trying to discern the long-term impacts of what governments are doing. If you're looking for the inside track on where markets are headed, one of the best informants is the bond market, especially the yield on the 10-year US Treasury bond. With the dollar index going down, signaling weakening confidence in the greenback, it's no surprise to see the yield on the 10-year Treasury going up. At the time we're recording this, it's now up to just over 1%, which may not seem like much, but in percentage terms, it's a really significant hike in a short space of time. What it's telling us is that institutional investors want a better reward for risking a decade-long exposure to the US dollar. It's a nod towards an inflationary future. Central bank asset purchases have risen from a pre-COVID level of $11 trillion to $17 trillion less than a year later, with the Bank of England's balance sheet now equivalent to 40% of our GDP. Money supply in America surged 20% between January and July 2020, the fastest ever rate of growth. And yet all this extra money is going to meet constrained supply due to lockdowns and a move away from global supply chains to more expensive local production. While we've seen lots of asset price inflation, we've seen little wage growth and therefore less consumer price inflation. That will gradually change as aging populations mean a shrinking workforce causing upward pressure on wages. With all these indicators pointing to inflation at some point in this decade, now might be a good time to top up your hoard of gold. Thanks for watching. If you'd like to see some previous episodes, click here. Don't forget to like the video, subscribe to my channel, and ring the bell so you don't miss out on any future episodes.